Now, we have to start first with the economic analysis and then derive what will be the market implication of it. If you look at the evolution of the global economy after the global financial crisis, there was an economic recovery and recovery of markets. This recovery was mostly an anemic subpar trend, a U-shaped recovery in most advanced economies, the US, the Eurozone, the UK, Japan, while between 2010 and 2012, the recovery in most emerging markets was more like a V-shaped recovery with rapid return to strong economic growth, even above potential economic growth. This is the situation between 2010 and 2012. This year, things have changed somehow. There are some signs that there may be an acceleration of economic growth this year and next year in the United States, in the Eurozone, in the United Kingdom, in Japan, and other advanced economies, while in many of the emerging markets there has been this year a slowdown of economic growth and market pressure on the financial markets, from equities to fixed income to currencies to credit. So I think that the two important questions that you have to ask yourself are, one, how strong is going to be the economic recovery in advanced economies? Is it going to be really resilient and robust towards potential or not potential growth? And secondly, whether the market correction and the pressure that emerging markets have faced in the last few months since May, is it a transitory, temporary phenomenon, or a sign that there's some more structural problem in the number of these emerging markets that might slow down growth and negatively affect their asset prices over the medium, longer term? I think those are some of the important questions that we have asked ourselves. The other initial observation I'll make is about policy. After the global financial crisis, there was a wide range of economic policies implemented to boost economic growth and financial recovery. Monetary stimulus, fiscal stimulus, backstopping, ring-fencing, and bailing out of banks, corporates, financial institutions, and even households. Today, however, policy-wise, the only game in town is monetary policy. Fiscal policy is constrained by the fact that there are large budget deficits and large stocks of public debt. Exchange rates are, of course, a zero-sum game. The ability of bailing out institutions is constrained by large stocks of public debt and political constraint. And therefore, the policy response to that weakness of economic growth, because until now the recovery of advanced economies has been very fragile and weak, has been rounds and rounds of additional monetary easing, more conventional monetary easing and then unconventional monetary easing. First, policy rates were cut lower and lower and down to zero. Now we've had 4 years plus in advanced economy of zero interest rate policy rates. After we reached zero policy rates, many central banks moved to quantitative easing, purchases of long-term bonds. Then they moved to credit easing, or CE, purchases of long-term assets of the private sector, or other policies to boost credit growth. And the final new innovation in central banking has been forward guidance, or the commitment by central banks to keep zero policy rates for longer than otherwise, as long as the economy remains weak and serves as a threshold for unemployment and inflation average. So whether it's zero or QE or C or FG, monetary policy has become significantly unconventional and going to stay unconventional for a long period of time. Now, some people, not myself, have been worried that this massive monetary easing is going to lead to inflation. People say with doubling, tripling, quadrupling of base money, eventually going to cause goods inflation. But if you look at advanced economies, inflation is the last of the problem that central banks are facing today. Inflation is below target in the United States, around 1% and falling. Inflation is well below the 2% target of the ECB at 0.7%. Other countries are borderline between inflation and deflation: Japan, Switzerland, Sweden, and even the United Kingdom, where until recently inflation was above target at 2%. There's been a very sharp slowdown in headline and in core inflation towards the target. So why is it that all this increase in money supply is not causing inflation? And where is the liquidity instead going? There are many reasons why we're not seeing inflation, and in my view, inflation advance economies for the next